Hello friends, welcome you back once again in my class. So today we are going to start module C of this chapter 20 that is called Treasury Risk Management. So organizational control refers to checks and balance in any system. So in treasury business also some risk is already involved. So basically treasury is divided into three parts. Number one is called the front office, that is called dealing room, and back office and called the mid office. Okay, so there is very important role of the dealing room because they'll be dealing with the customers directly. Okay, and exposure limit protect the bank from credit risk. That means everywhere some exposure limit has been put. That's why I told you that everywhere, like in any particular sector, you can give this much exposure, like in agriculture sector, corporate sector. So that limit always protect the bank from the credit risk, because if one sector is going down, the other sector will save you. The counterparty risk is the bankruptcy or inability of the counterparty to complete the transaction at their end. So what happens, sometimes the customer is not able to pay the if his dues are there in time. Okay, sometimes maybe by default or sometimes inability. So that is called the counterparty risk. So exposure limits are fixed on the basis of counterparties net worth, market reputation, and track record. Okay, sometimes you might have seen for that housing loan. Okay, so when giving advances for the housing, we always see the what is the collateral value and what is the paying capacity of the customer. We see the financial background of the customer. Based on, we fix what limit is to be given to that customer. Okay, so this is the meaning of the exposure limit. So RBI has imposed ceiling of 5% of total business in a year with the individual branches. Okay, and limit expose are preventive measures to avoid or contain losses in adverse market condition. If market condition is going adverse, then this limit will save. That means further loss will not happen. That is like a stop. Okay, and trading limits are three kinds: limits on deal size, limits on open position, and stop loss limit. Limit size, deal size means, okay, like one particular branch will be restricted. Okay, this branch can deal only one size to one customer, like say $1. Okay, so one deal is consisting of 1,000 so USD dollar. So this is the limit on deal size. Limit on open position means on a closing day of that particular day, okay, this bank can hold, or that mm, authorized dealer can hold. Okay, this hand can hold only 50,000 US dollar by the day end. So that if tomorrow some rate is going down, so rates would be stopped. And stop loss limit is the where the further loss is stopped. That means we fix the limit. Okay, if rate of the US dollar is going 65, okay, 65.5, if below it is going down, then we automatically will sell the dollars, so convert it to Indian currency. And open position refers to the trading position where the buy and sell position are not matched. That means in the day end you'll find out the either some dollar is left over or dollar is short. Okay, that is called the open position. All the forward contracts are revalued periodically, let's say every month. So forward contracts are revalued, and we'll see whether we are going as for loss or we are incurring the profit. Okay, and we have already talked about the stop loss. Okay, the two main components of the market risk are liquidity risk and interest rate risk. This is very important. Okay, that means two main components of the market risk are the liquidity risk and interest rate risk. Liquidity risk implies cash flow gap which could not be bridged. Okay, liquidity risk means, like in bank, you must be getting, like in particular day you are getting FD for 5 lakh rupees, but same day you are giving loan for 5 lakh rupees. Okay, so this is called the liquidity gap. FD you are getting 50,000, sorry 50,000 and you get giving the loan for the 5 lakhs. So this is called the liquidity mismatch. Okay. And interest rate risk refers to rise in interest costs eroding the business profit, resulting in foreign asset price. That means if interest rate are changing, so what will happen? Whatever if interest rate of FDs are increasing, so what will happen? Your profit will decrease. And interest rate risk is present wherever there is mismatch in asset and liability. Because if liability is more, because if liability is more, you have to pay more interest. Okay. And if the currency is convertible, the exchange rate interest rate change very important role. Okay, attracting the foreign investment inflow and into the secondary market. And market is confluence of liquidity. So what is the market risk? So market is a confluence. Confluence is or merge. Liquidity risk, interest risk, and exchange rate risk, and equity risk, and commodity risk. Because all these are traded in market. You can see all related to market only. Commodity, equity, exchange, and the interest rate all depends on the market condition. So the market rate risk is nothing but confluence of all this. And BIS defines market is as follows: the risk that the value of an or off balance sheet position will be adversely affected by movement of an equity, interest rate market, currency exchange rate, and commodity. So that's why these has been included in the confluence of market. Okay. And market is also closely connected with the ALM. ALM is asset liability management. Market risk is also known as price risk. Keep in mind. Okay. Market risk is also known as price risk. And two important measures of risk are value at risk and duration method. VR and duration method. Okay. So you can measure the risk by these two methods. So now we'll take one example here. So value at risk at 95% confidence level implies that 5% probability of incurring loss is there. Because confidence level is 95%, so 5%. If confidence level is 99%, then 1% probability is there. So we are an estimate of potential loss always for given period at a confidence level. So for VR, you have to take given period and confidence level. These two are main important component of calculating the VR. Means value at risk. So there are three approaches to calculate VR. Number one is called parametric approach, Monte Carlo approach, and historical data. So VAR is derived from a statistical formula based on volatility of the market. Parametric approach is based on sensitivity of various risk component. Under Monte Carlo model, number of uh, scenarios are generated at random and their impact on subject is studied. And duration is widely used in the investment business. So in the investment business, the duration is very, very important. The rate at which the present value equals the market price of bond is known as YTM. That we already discussed in the bond chapter of ALM. Okay. And yield and price of moves in inversely proportion. And duration of weighted average measure of life of bond. Weighted average measure of life bond where the time of receipt of cash flow is weighted by present value of cash flow. Okay. And duration method is also called Macaulay duration, and its original is the Frederick Macaulay. Okay, so you can remember the name Macaulay duration. So it's used in duration method also. Longer the duration, greater the sensitivity of the bond price to the change in the interest rate. So a proportionate change in price, I just read it here. A proportionate change in price corresponding to change in yield is possible only when the yield is a linear curve. That means we can get the linear curve also. like straight curve we can get. So they are already discussed in ABM class. Now derivatives are used to protect treasury transaction from market risk. So treasury also they deal with the derivative to protect from the market risk. Okay, so derivative was used in managing the balance sheet risk in ALM. So treasury transactions are high value and relatively need low capital. So treasury transactions are high value and relatively need low capital. So we have already discussed that the maintenance of treasury wing is very low because they deal with very big size of the capital. That's why they require less capital. They require high value capital, but the expenditure is very less. The maintenance is very low. Market movement are mainly do speculation because many people know they want to earn the profit so quickly. So there is a quick change in the market is there. So VR is maximum loss that may take place within time horizon at given confidence level. Okay, confidence level. VR is the maximum loss that may take place within a time. So we have to remember that in VR we have to remember two factors. One is the factor time, other is the confidence level. Okay. Now discussing the leverage is the capital adequacy ratio in case of company, that is debt equity ratio. Okay, so leverage is nothing but it is capital adequacy ratio, and in case of company it is debt equity ratio. So with this we'll move ahead and we are going to start our NAV charter. This is called derivative products. This is unit number 20. Okay, now Treasury uses the derivative to manage the risk, including ATL. Okay, to cater needs of corporate customer and trades because they issue the derivative so that the loss can be mitigated. The value of derivative is derived from the underlying market. That means when you derive a basket of commodities, so their rate will be dependent on the underlying market. Means whatever the commodities you have put in one basket, from where the commodities has been derived, the rate will be dependent on that commodity. And derivatives always refer to the future price. That means we trade in future also. The derivative that can be directly negotiated and obtained from banks and investment institutions are known as over-the-counter product. That means when we don't go to the counter, don't we go to stock exchange market, or we don't go to physically. That means in telephone or some net, whatever gateway we can use. So derivative that can be directly negotiated and obtained from banks, investments are known as over-the-counter product. Okay, derivatives are of two types: number OTC product and exchange traded product. So I told OTC means without involvement of exchange, nobody will come, directly you can deal. And one is the exchange traded, that means we have to go to stock exchange, otherwise do online or offline. Okay, but nowadays we are doing the online transaction only in the exchange also. The value of trade in OTC product is much larger than that of the exchange traded product. So that means the value of trade, now that means OTC is prevailing nowadays. So OTC is the value is more as compared to the stock traded product. That means OTC is more popular than the stock exchange traded product. The derivative products can be broadly categorized into option, future, and swap. So this is very important point. Now options are, the option is there, future is there, and swap is there. Option refer to contract when buyer has an option, or you can say right, but no obligation to exercise the contract. So that means put option is there and call option is there. Okay, so put option means if seller has option put, that means now he has right to sell or not to sell. Call option means the buyer have the option to call it or not to call it. So he has the option, but he has no obligation. Means he can exercise the option or he may not exercise the option depending upon the market situation. Okay. So put option, call option, we have covered. Yeah, now prefix rate is called the strike rate. Prefix rate is called the strike rate. Then when we do the dealing, whatever rate is fixed, that is called the strike rate. It's very important. Okay. So you can remember what is called the strike rate. The prefix rate is called also strike rate. And options are of two types. One is American type option, another is a Europe type. American type and Europe type. In American type, where option can be executed at any time before the expiry. Okay, that means buyer and seller have the option to exercise their option, but in European type, option can be exercised only on the expiry date. In India, we use the European type option. So this is very important point here. That means in India, which option we are using? We are using the European type option. Okay. A dollar put option give right to holder to sell the dollar. So put means he can sell or not to sell. If strike price is same as the spot price, it's known as money. Very important. That means if spot price and strike price both are matching, then we'll say it is a money. Okay. So spot, just I remember, Tom is there, cash is there, Tom is there, spot is there, and forward is there. So spot is +2. Huh? Okay. So this is called money. Next, option is in money, then when ITM. Okay. In the money. Option is in the money, that means ITM. If strike price is less than the forward rate, this is very, very important. ITM is strike price is less than the forward rate. In case of call option or strike price is more than the forward rate is in put option. So this you have to remember. Okay. ITM is called ITM if strike price is less than the forward price. Means a strike price is less than forward. Where what option is there? Call option is there. Okay. And S is greater than F if put option is there. Okay. This is called ITM. Now opposite to this, same opposite to this. Option is out of money, OTM. If strike price is more than, now you reverse everything. Okay, strike price is more than the forward rate. So I'll just write here the greening. Then means strike price is greater than F in call and S is less than F in put option. So you can remember and you can just reverse everything. Okay, so you can remember ITM, S is less than F and S is greater than F, call and put option respectively. Okay, in the context of option spot rate is the rate prevailing on the data maturity. Okay, this is very, very important. In the context of spot rate, in the context of option spot rate is the rate prevailing on the data maturity. Okay, so on the data which maturity, whatever option will be that the spot rate prevailing the data maturity. Okay, profit potential of buyer is an option is unlimited. So profit potential of buyer of an option is unlimited. Okay, and option seller potential loss is unlimited. This is very, very important point you can remember. So due to the available option, that means profit potential of buyer of an option will be unlimited, and option seller potential loss means for seller it will be loss will be unlimited. Okay, because when buyer is earning the profit, then naturally the seller will be incurring the loss. Okay, so in this way you can remember. The payment of difference between the strike price and market price of an on expiry is known as cash settlement. Okay, so that means whatever option has been carried out, if you do the settlement, means So settlement will be done by the difference. Okay, strike price and the market price. Okay, so whatever the strike price and market price is there, you have to settle, because either you might have incurred the loss or you might have gained the profit. So that is called settlement. Okay, the buyer of an option pay premium to the seller for the purchase of option. Okay, and option premium is paid upfront. Option premium is paid upfront means you beforehand you have to pay this option. Okay. So stock option is the right to buy or sell equity of a company at the strike price. That means if company is taking the stock option, that means company has got the right to buy or sell the company. Options are used to hedge against the price fluctuation. That means if market price is changing, so you can use this option. Okay. A convertible option may be the bondholder option of converting the debt into equity on the specified term. So if somebody has purchased the bond or holder and he has got the option, so he can convert or may not convert. A bond with call option gives right to the issuer to prepay the debt on a specified debt. Okay, that means he can call the bond, then he can pay the debt. Futures are forward contract. This point is very, very important. Futures are always forward contracts. Under future contract, the seller agrees to deliver to the buyer specified security, currency, or commodity on a specified date. So if you have entered in the future contract, that means seller agrees to deliver to the buyer whatever security you have done, whatever currency, whatever rate you have decided, commodity, and the on a specified date. Okay. Future contracts are of standard size with prefix settlement dates. Okay. So future contract, like say, we can say, okay, we can make a lot of, okay, $100. If it is commodity, you can say, okay, 100 quintal commodity is there. So you can, the standard size will be there, and prefix settlement date is there. That means by this date you have to settle whether loss is there or profit is there. If loss is there, you have to pay. If profit is there, you get money out of that. Okay. A distinct feature of future is the contract are mark to market. That means on the prevailing market rate only you have to rate that commodity market daily, and the member are required to pay margin equivalent to daily loss if it is there. That means if market rate are changing and you have gone through the agreement of future contract, and if loss is there, that means you have to pay. So how it is paid? From your account is be deducted. And in case of future profit is there, so you will get the money. In case of future, the exchange guarantee all trades through its member. In case of default or insolvency of any member, exchange will meet the payment out of the trade protection fund. So in case the exchange is involved, so they will take money from their account. So how they will pay? They will recover money from the members. In case of default or insolvency of any member, exchange will meet the payment out of the trade protection fund. So exchange maintains one trade protection fund. From there they pay. Currency futures serve the same purpose as forward contracts conventionally issued by bank in foreign exchange business. Okay, and futures are standardized and traded on exchange, but forward contracts are customized OTC contract. Keep in mind. Okay, futures are standardized, traded on exchange, but forward contracts are customized OTC contracts. So this is very different. Future FE. You can remember like this. After F, it comes E. Okay, and C is very far. C and OTC very far away. So FE and CO, that means future exchange and forward contract, forward contract, forward contract, over the counter. Okay, likewise you can remember. So future, exchange, and forward. Forward means OTC means over the counter. The future can be bought only for fixed amount and fixed period. Okay, that means the amount is fixed because lot size is fixed and period is also fixed. Swap is an exchange of cash flow. The swap, I told you, that is exchange of, it's just a conversion of rupee to dollar and dollar to, or any foreign exchange. Okay. An interest rate swap is an exchange of interest flows of an underlying asset or liability. Okay. Cash flow representing the interest payment during the swap period or exchange. Okay. Yeah. Now the next important point is the USD, the benchmark rate are generally LIBOR, London Interbank Offer Rate. There is also one rate is a MIBOR, Mumbai Interbank Offer Rate. Is announced daily basis. MIBOR is announced daily basis at 9:50 a.m. by NSE. And MIBOR is used as a base rate for short-term and medium-term lending. Okay. Interest rate swap is shifting of interest rate calculation from fixed rate to floating and floating rate to fixed rate and floating rate to floating rate. That means we keep on changing depending upon the situation so that interest rate risk is mitigated. Okay. Now, next, Quanto Swap. This point is very, very important. Quanto Swap refers to paying interest in home currency at rate applicable to foreign currency. Okay, so Quanto Swap refers to paying interest home currency at the rate applicable to foreign currency. Coupon swap referred to floating rate in one currency exchange to fixed rate to another currency. Coupon swap is you have changed the floating to fixed one currency. Quanto refers to paying interest in home currency at the rate of foreign currency. Quanto. In Indian rupee market, only plain vanilla type swaps are permitted. Plain vanilla means simple, rupee to rupee, simple. No, nothing is direct. A currency swap is the exchange of cash flow in one currency with the currency of another country. So this is called currency swap. The need of currency swaps arises when loan raised in one currency is actually required to be used in the another currency. That means you have to swap the currency. You have raised the like loan in Indian rupee, but you are paying to the customer located in another country. Interest rate swap and forward rate agreement (FRA). IRS-FRA was first allowed by RBI in 1998. So just you can remember the date. Banks and counterparty need to execute ISDA master agreement before entering into any derivative contract. Okay. So what is full form of ISDA? So full form of ISDA is International Swap and Derivative Association. So banks and counterparty, they have to execute ISDA master agreement before entering into any derivative contract. It means ISDA means International Swaps and Derivative Association. A right to buy is call option and right to sell is a put option. Call means calling, you are calling, then you are buying, and sell means you are putting the option. Okay, put option. Swaps are used to minimize cost of borrowing and also to benefit from arbitrage in two currencies. Okay, swaps are used to minimize cost of borrowing and also to benefit from arbitrage in two currencies. Okay, currency and interest rate swap with basic structure without in build position or knockout level are plain vanilla swap option. Okay, currency swap with basic structure, basic structure without build position means only simple. So this is called plain vanilla type swap. Okay, so now I'll move the next chapter. This chapter is 21. So this will be the last of your model C. And so this is called Treasury and Asset Liability Management. The risk arise out of mismatch of asset liability of bank. Okay, so main thing is the risk may arise anytime there may asset and liability of the banking system. So this is the main function of the treasury, so that asset and liability both are mismatched. Assets should not be more, so that they have to paying the more interest, and liability should not be more, so that they are paying more interest, and asset they cannot create more without liability. So ALM is defined as protection of net worth of the bank. That means you have to protect the net worth of the bank by asset liability management. So liquidity risk translates into interest rate risk when the bank has to recycle the deposit fund or roll over a credit on market determined terms. So what is liquidity risk means? Liquidity risk means like bank is having some FDs, and out of that FDs or deposits they are giving loan to the customers. Okay, so many FDs putting together they'll be giving loan to the different customers. So this is called the liquidity management. Okay, and so liquidity implies to the positive cash flow. The difference between source and the use of fund in a specific time band is known as liquidity gap. Keep in mind the difference between source and use of fund in a specific time band is known as liquidity gap. Means your source of fund and your use of fund is known as liquidity gap, which may be positive or negative. That means if your source is more and fund use is less, that means you're positive, and source is less and fund is more, then it is your all negative. Interest rate is measured by the gap between interest rate sensitive asset and interest rate sensitive liability. Okay, so you can calculate the what is the interest rate sensitive asset is there. That means direct it is having impact on the assets, and interest rate sensitive liability. So it's called the interest rate risk. Okay, asset and liabilities are rate sensitive when their value changes in reverse direction corresponding to change to market rate of the interest. Okay, that means asset liability they might change depending upon the change in the interest rate. The gap management is only way of monitoring the ALM. The duration and simulation methods are used to make ALM more effective. Simulation method, we can create one our structure. We can generate one we can generate one system, and by simulation method, and we can practice for that. So ALM will be more effective. Derivatives are useful in reducing the liquidity and interest rate risk, and derivatives replicate market movement also. That means if you use the derivative, you can control the market risk, and derivative can also be used to hedge high value individual transactions, and derivative transaction is independent of the banking transaction. This point is very important. Okay, derivative transactions are independent of the banking transaction. Treasury products such as bond, commercial papers are subject to credit risk. Okay, because you are once issuing the bond or your commercial paper, that means they are subject to credit risk. Credit risk in loan and bond are similar. Unlike a loan, bond is tradable and hence it is more liquid asset. Okay, nowadays the conventional credit is converted to tradable treasury product through securitization process by issue of PTC. Okay, securitization infuses liquidity into the issuing bank and frees the blocked capital. That means if block capital is there, so you can issue the security. Transfer pricing refer to fixing the cost of resource and return the asset of the bank in a rational manner. So transfer pricing mechanism, and a transfer pricing mechanism fixing the cost of resource and return of asset by bank in a rational manner. In a multi-branch transfer, pricing is particularly useful to assess the branch profitability. Okay, in a multi-branch transfer, pricing is particular referred to assess the branch profitability. That means you can transfer to multi-branch also. ALM policy prescribe composition of ALCO, asset liability committee. Okay, and operational asset of ALM. That means ALCO will be the operational asset of the ALM. Okay. Liquidity policy prescribe minimum liquidity to be maintained. This is very important. Okay, otherwise bank may go bankrupt. And customer will line up to get their money, but you are not having money to pay to the customer. Okay, Modern banking may be defined as risk intermediation. Okay, so how much risk you are maintaining or risk you are containing, that is called the modern banking system. Market risk comprises of liquidity and interest rate. This is already defined here. Okay, banks are highly sensitive to liquidity risk as they cannot afford to default or delay in meeting their obligation to depositors and their lenders, because it will give them negative publicity. That is very bad for the banking system. Okay, so one more important point is the liquidity and interest rate sensitive gaps are measured in a specific time band. Okay, liquidity and interest rate both are sensitive, and a rate sensitive gap are measured in a specific time band. Treasury connect core banking activity with the financial market. We have already discussed this point. And derivative and options are used in managing the mismatch in bank's balance sheet. Treasury is also responsible for transfer pricing. So this is the main work of Treasury. A situation where depositor of bank lose confidence in the bank and withdraw their balances immediately is known as run on the bank. Okay, run on the bank. That means if liquidity crunch is there, like it happened recently, the Bank of Maharashtra, liquidity crunch was there. So all customers, they lined up inside the branches, and branch was not able to pay them. Okay, so situation where the depositor of bank loses confidence, okay, and withdraw their balances immediately, known as run on the bank. Securities that can be readily sold for cash in secondary market are liquidable securities. Okay, and ratio of interest rate sensitive asset to ratio of rate sensitive asset to the rate sensitive liability is known as sensitivity ratio. Okay, that means rate ratio of interest rate sensitive asset means IRSA and IRSL. Okay, so it is called sensitivity ratio. The capacity and willingness to absorb loss on account of market risk is the risk appetite. How much risk you can absorb, or how much risk uh, you can hold, without any further bad name. That's called your risk appetite. So this is called capacity and willingness. Capacity should be there. Capacity will come only when the capital is there. So, and willingness to absorb, that means taking the risk, is called the market, is called the risk appetite. So with this we are ending our module C. Very soon we'll start our module D also. So please stay tuned with me. Thank you very much. Have a nice day. Good day.